Who would have thought?
They said that anyone that is doing this without board approval, which is majority of them, all those shares are basically void and are therefore meaningless. It's probably going to zero.
What I found hilarious was there's 16 layers in some of these. You're now 10 layers deep, and this poor retiree couple from Florida has probably sunk $100K into the SPV, thinking that it's their meal ticket, but they're likely fueling some young wannabe broker in New York's coke habit now.
Welcome back to our second episode.
We did it.
Yeah.
We did it.
Finally. So this is the Debrief, and I'm Nawaz Ahmed, and we have my partner Vignesh here. So we have some interesting conversations that we are excited to get into. So you want to start us off?
We have a ton of really interesting stuff to talk about today, but we got to address the elephant in the room, or dare I say, the bird in the room. Last podcast, we had a really substantive conversation around Allbirds. And then something happened right after it. And so give us a sense, Nawaz, what transpired immediately after our conversation, and how timely was that conversation that we had?
Yeah, the timing was incredible. Like, we recorded, and then, the very next day, so not even 12 hours after, the news came out that Allbird is pivoting. So the pivot is incredible. So if you think about what Allbird is, which is a direct-to-consumer shoe company, they are pivoting now to AI. And the name escapes me, but it's a brand new name with like something.ai. And the fascinating thing, once that news came out, the share price of Allbirds just rocketed, because now we have an AI company in the place of a direct-to-consumer shoe company.
Who would have thought?
I would never have picked that.
Was that on your bingo card at all? Yeah. I did not see that one coming, but I pulled up the actual investor relations update that Allbirds put out. Oh my God, it's beautiful. It's beautiful. Listen to this. They raised $50 million in a convertible note that pivots the core business, as you said, to AI compute infrastructure, to a fully integrated GPU as a service and AI native cloud solution provider. And the company's new name is, as you said, Newbird AI.
Love it. GPU as a service. I wouldn't mind some GPUs in my shoes.
Yeah, I mean, shit, that's all of us were like, damn, how do we get in on that? But, as we park the craziness of it for a second, forgetting that it's Allbirds, does it make sense to take out $50 million in convertible note financing to buy effectively GPUs and then lease them out for compute resourcing? Like, do you think that's a worthwhile business for what is technically still a publicly listed entity right now?
Yeah, probably not. Like, it's crazy. Like, I don't understand it. I'm fascinated to understand like who the investors in that convertible note was, because it just doesn't make sense. And the quantum is also tiny. Like, we're talking about GPU compute. Like,
yeah,
the numbers don't add up.
They don't make up any sense, do they? Because I think, even as a side note, and Nawaz, you'll know this, we seriously looked at buying some H100s here at GD1. So people might not believe that. We were thinking of buying a distressed company's inventory that they were selling, so to speak. And even secondhand, that shit is like $500,000. So let's say straight out the retail gate, we're talking $1 million per proper server cluster.
Yeah.
50 million. Getting 50 of these, is that enough to like what? It doesn't make any sense.
No, exactly. And I think the share price reflected that the very following day, where it kind of fell back down to reality when people started realizing it probably doesn't make sense.
So net, does that mean it turned into a meme stock for like 12 hours and then
or some crazy insider stuff. Because like, my God, that run up and then the sell down was actually crazy.
Yeah. Next level.
Yeah, it's reminiscent of this company back in the, I think it was 2021 when crypto was booming. Iced tea company on the New York Stock Exchange rebranded to they put blockchain in their name.
I remember reading. Yeah.
And that same thing happened. Like the stock prices off because of the hype and then came back down eventually.
I can't believe it. Still, $50 million was the convertible note financing.
Insane.
Like, who's buying this shit?
Yeah, no clue.
Funnily enough, like at some event yesterday, I saw Tim Brown, and I was like seated 2 seats away, and I had to really fight the urge to be like, "What do you think?" But it's fair to say he's got nothing to do with all of this now. Yeah. But still, the curiosity exists to be like, "What is happening? What is?" So I got to say, shout out to the Ice House guys because they probably know what's happening. They're probably asking him nonstop, what the heck has happened here? But man, it's hilarious that happened. We recorded the pod the next day, and we were just like, wow.
Yep. And it had to be addressed.
Well, we've addressed the bird in the room. We got that out of the way. We're now going to talk about some more interesting topics.
Yeah. And you mentioned, who are the buyers? I think that brings us to this next topic, which is, I'm sure everyone has heard of Claude, one of the leading LLM models powered by a company called Anthropic. And Anthropic, is on this crazy run, growing revenue, growing valuation, currently doing like a $900 billion venture round. And yeah, in incredible numbers. But a couple of weeks ago, Anthropic put out a press release and updated their website, basically addressing all these people who are buying or selling secondary shares into Anthropic. And essentially, high level, they said that anyone that is doing this without board approval, which is majority of them, all those shares are basically void and are therefore meaningless. So there's a lot of these, and there's a lot of these things out in the market, like SPVs, even some of these like pre-IPO exchanges that are trying to sell Anthropic stock that people are putting real money into. It's probably going to zero.
Yeah, I think it's pretty scary. Do you know what caused it? Because I was reading up on that too, and that seems pretty hilarious.
Tell me about it.
So apparently this guy was on Twitter, and he posted about how he made more in one transaction than he has ever made in his net worth or lifetime. And people were going, hey, like, what was this one transaction you did that made you money like this? And then he said, it was facilitating brokerage of the Anthropic secondaries and like SPVs and just facilitating those sales. And I made millions of dollars doing it. And then what followed on X was this really, how do I say it, devolved conversation around, is this ethical? Is it legal? All this sort of thing. Do you have board approval? That thread is now deleted. Yeah. But it seems like people were watching, especially on the Anthropic side. And once that caught wind, it kind of set off this chain reaction where Anthropic then went, you know what? Fuck all of this.
Yep.
Banned. Blanket ban.
Yeah.
And so that's kind of set off this really crazy sequencing of things. But I find it hilarious that it was simply some person on the internet who posted about how they made more in this one transaction, facilitating this transfer of what was technically not legally allowed.
Yeah.
And then here we are.
Yeah.
A blanket ban.
Yeah. The numbers are huge because like this once that news came out, one of the exchanges, secondary exchanges that were offering Anthropic stock to like any kind of investor, they came out and said, in terms of the interest, they've had like not just, regular retail type investors, but large family office institutional funds where the interest just to that specific marketplace is up to $1 trillion of interest. So like the interest is there, but Anthropic is tightly controlling it, especially with their own primary fundraisers ongoing.
And correct me if I'm wrong, but like there was tokenization happening as well.
Yeah. Well, there's a bunch of these kind of
like on Solana and stuff.
Yeah, there's a bunch of these startups, and even the likes of like Coinbase is playing around with tokenization of like
the SPV
IPO
interest.
stocks and pre-IPO stocks. So when it comes into the details, it's a little bit blurry what exactly makes up the pre-IPO stock. But yes, there is a bunch of that happening, and not just with Anthropic, with a lot of pre-IPO stock, including OpenAI and ChatGPT.
Yeah. Well, I got to say, all of this is super reminiscent of the Matryoshka doll. Do you remember that thing? Like that kind of like, maybe I'll get it wrong, but like it's called colloquially a Russian nesting doll.
Yeah.
But you open that shit up. Oh, it's another one. It's another one. Yeah. And so it kind of feels like we're going down this path where everybody thinks they've got this SPV, but it's essentially SPV wrappers on wrappers on wrappers. And so, what's your take on where this is heading? And I want to get a clear perspective on Anthropic's banned it. Can they enforce it? And then secondly, how does it end? Because we've now got that Russian nesting doll problem happening.
Yeah.
And so like, who's making money and how much money?
Yeah. The people making money are just the people facilitating the SPVs.
Yeah.
And they're just taking like the management fee clip.
Yeah.
And they're kind of riding away because at the end of the day, the stuff might not happen. But essentially how that money is being made for like people that don't understand SPVs, SPVs mean special purpose vehicles. They're basically a way that you pool capital to invest into a stock or into equity. And in the case of these big companies like Anthropic, these layers of SPVs, as you were referring to with these Russian nesting dolls, is basically in the case where somebody who has direct access to Anthropic equity, they put that access into a SPV, and they're saying we have 20 million we can invest into this SPV, and this is directly going into Anthropic. This specific SPV is called a layer 1 SPV. So this is like first layer that goes into the company directly. But that crazy thing that's happening is that now there's like multiple layers of SPVs, which are like, there's a layer SPV, which is going into that first layer SPV, and then a third layer, which is going into that second, which is going into the first.
Yeah.
So again, if you remember, the first one was 20 million. The second layer might have been trying to raise 5 million. And then the third layer might have raised like $1 million. Each of these are made up with these individual investors putting in like, anywhere between 10 to 500K into these companies. But each SPV comes with management fees. Each SPV comes with carry. So at the end of the day, when you peel back those layers, if you're at the bottom of the tier of that layer, you're paying like nearly 90% in management fees up the layering. And then as the carry flows down, you're probably left with nothing.
Yeah. And I think that's a really interesting point because I love just diving into some of the math. And I was looking at the fees, and it's like the standard layer fees are like a 15% setup fee. So I didn't realize SPVs have this kind of like door charge fee. So a setup fee. And so you get the door charge fee, the setup fee, but then you have that management fee. And then you have the carry. And so like, what's the duration of an SPV? Like, so let's say this is an Anthropic, for ease of sake, let's say it's a SpaceX SPV. Yeah. Before we get to SpaceX, we'll just diverge slightly. SPV, been around for 10 years. Is an SPV 10 years then? Like it's as long as the asset?
Correct.
Okay. And so we're talking how much percent management fees on an SPV?
Could be 1 to 2%.
Okay. So let's say it's a 10-year SPV. We're talking 10% in fees straight out the gate. That's ignoring the 15% setup fee.
Yes.
So we're already at 25% fees. That's ignoring the 20% carry.
Yes. And just to emphasize what carry is, that's basically if the SPV makes a profit, carry is what goes to the person who set up the SPV. That's the profit that they make, which is 20% of whatever is left over after returning capital to investors.
So we're sitting at like 45% in fees. Is that right? And so let's just say we chucked in $100. That's like literally at best layer one, $55.
Yeah.
Okay, is that kind of the
That
rough?
sounds about right, yeah.
And so now you're layering on layers. Your math checks out. I think you get to 3 layers deep, you're probably making nothing. You get to 4 layers, you're definitely making nothing. But what I found hilarious was there's 16 layers in some of these. Can I ask a stupid question? But like, you do a lot of SPV investing from the crypto side, Web3 side, seeing some deals. How do you sense check? Surely there's a bit of like mechanisms built into all these structures to understand where you are in the layer thread, or is it up to the buyer to really dig deep and understand where they are in this stack?
It's very much up to the buyer. To be honest, the layering thing is relatively new.
Okay.
Right? So like usually this whole layering concept had to be explained from probably 6 months ago.
Yeah.
Until then, it was generally just SPV means direct into the company and you're on the cap table, as in the SPV is on the cap table. But yeah, what that means now is like they have to specify what layer that they are. So they might say they're a layer 3 SPV, but you need to know what that means. Like if you're somebody who has never really looked at these things before and you see like a layer 3 SPV in Anthropic and you don't actually dig into what layer 3 means, like, yeah, you're probably going to be, at the bottom of that stack and not make much money. A problem. And I think people are trying to like emphasize that a little bit more. And like some of the SPV platforms are trying to make it more highlighted to like inform their investors. But at the end of the day, you still need to have some idea.
Yeah. It feels like a buyer beware problem, right? But I'm still kind of shocked by all of this layering. And then the second part, which I want to get your thoughts on, and like I've got a view here, which is the enforceability. So Anthropic's come out and they're like, all right, we're going to ban this.
Okay.
So if you think about a big company, they're probably banning it because they don't want to see their stock being sold around, whatever, perhaps some brand reputation, whatever.
Yep.
But can you really enforce this? And when you're kind of doing all of this, like several layers deep, and there's on-selling and there's high demand, far more liquidity demand than there is supply, is it worth the time and effort to be going after this?
I feel like it probably isn't for a company like Anthropic, but when it comes to the likelihood of enforceability, I think it's possible.
Yeah.
And mainly because as far as Anthropic has gotten over the past, 7-8 years it's been around, they know who their primary investors are, right? So they know everyone who's on the cap table. And they know if one of those investors are in via an SPV, they know who that is. What is relatively easy for them to then identify, again, if they care to do so, because this has become so wide blown now, is like where the layers are coming from, like which is the top layer investor who's kind of given rise to these layers. And then it will be really based on like the quantum that actually ends up flowing down, that they might take that.
True. So it's probably a different scale thing where let's say one of the founders of Anthropic was doing secondaries. That's like an egregious thing where likely the board would go, hey, no, that's not going to happen. Versus some like, I don't know, employee 1,000 who's like selling a few million in like equity, right?
Yeah.
Okay, that's probably, it's a relative thing, but I did find it interesting that it's like, there's so much focus on, we're going to ban it, but how are you going to enforce it? It sounds painful. And it's like hurting, not even cats, you're hurting ants.
Yeah, it is. Yeah. And at the end of the day, it will be like retail and like general investors are going to get hurt by that ban.
Speaking of all that, and shifting to SpaceX, because that's the bigger time bomb. I heard a really sobering anecdote on the SPV stuff, which was, I think it was Matt Grimm. He was on the TPBN podcast, and then he said a really sobering anecdote, which is on the SpaceX SPV layering. You're now 10 layers deep, and this poor retiree couple from Florida is probably sunk $100K into the SPV, thinking that it's their meal ticket to retirement. But they're likely fueling some young wannabe broker in New York's coke habit now, because he's facilitated this thing. And so that's super sobering, because when you think about the scale of outcomes, Anthropic's not going public yet. SpaceX is filed its filings with the SEC. We're talking, 80 to 90 billion raise capital?
1.75 trillion valuation, yeah.
Even a billion of that, in SPVs is a lot.
Yeah.
It's huge. So what is your take on what's going to happen there? That's way more timely than the Anthropic stuff.
Yeah. Well, this is going to play out as the IPO happens over the next kind of quarter. So realistically, I'm sure the stories will start coming out when somebody was a layer 5 investor in some SPV that went into SpaceX. The actual return they got is zero, regardless of it being such a massive outcome for any primary investor. So I'm sure these stories will come out as soon as the deal is done.
Jeez. It makes me nervous. And I think I was also reading here, it's there are ETFs holding exposure to SpaceX through structured SPVs. Wow, there's a ton of financial engineering that's been going through the system. I've got a view that this is gonna have a profound impact on this global liquidity. But what's your take on the markets? With SpaceX going public, yes, retail investors will get hurt, but what's your take more broadly on the health of all these tech stocks when all this happens?
Yeah, that's a interesting question, because I think the IPO is the largest IPO ever, and SpaceX, the IPO pricing is also significantly more than their earnings. And I think their S1 filing showed that they're actually making losses, even though it's a gigantic IPO. So, and then when on the other side, you have these private companies generating huge amounts of cash like Anthropic and OpenAI. So I feel this IPO is going to just reset the market a little bit based on what actually happens. No doubt it's oversubscribed and people are going to buy into it, but once it hits the market and how the next kind of the trading days look like and what the market really values SpaceX at is going to be fascinating when it comes to, as you think about just the broader public markets and then how that multiple impact affects these larger companies where, that kind of comparable makes sense. It's going to be fascinating, yeah.
So I was at the High Tech Awards and I was catching up with one of our LPs who is a wealth advisor. And he was saying the $80 billion that they're raising is obviously an infinitesimally small portion of the floated capital that they have. Yes. But it's a huge portion relative to other listings, right? It's almost a market cap.
Yes.
Of
exactly.
Some other companies. Case in point, I think Canva was prior, its private market cap was 66 billion. So the order of magnitude is changing here.
Yes.
And in speaking with John outside as well, we were talking about when a big company goes public, it has to get into the indexes. And you have to, let's say the S&P 500 or 50, whatever, you have to trade out of positions. Then they have to trade into a SpaceX and buy in. $80 billion is a lot of float. Is that going to tank tech stocks because they're going to have to sell positions in S&P 50, whatever, to then make space to buy a SpaceX in all of this?
If it's tech-specific ETFs, then I'm sure the bottom tier of those
will fall out.
Yeah, will fall out.
You heard it here. This is not financial advice. This is Nawaz and Vignesh pontificating on where we can try and dump some meme stocks and get some capital.
And like a funny thing, like a more direct story on like the layering of SPVs is like when I was trying to set up a SPV last year into Replit, and I had gotten access to a layer 1 SPV, which was going directly onto the cap table, and I was trying to set up a SPV that goes into that. So technically my one would have been a layer 2. I wasn't going to charge any fees on carry on it, so it would have been clean.
Pass through.
Yeah, it would have fully passed through, and there was no like impact apart from whatever we were paying like that initial SPV manager. But yeah, once it was funny, while I was working through that and talking to some investors, that the whole layering news had just hit the market about these SPV layering. So one of my investors who was going to commit into the SPV asked me that. He messaged me saying, what layer is this? Like, where do we kind of sit in the stack? So once I explained to him, it made sense. But as soon as that news hit, people started to really rethink all of the investments they were committing to or they've done in the past.
I mean, it also feels like, I don't know what the pricing you were going to get on the Replit layer 2, but it sounds like in some of this stuff, people are pricing SPVs at the full expected market cap of listing. So for example, at SpaceX, there are some SPVs being sold at the full like 1.5 plus trillion dollar valuation. But then if you kind of do the mathematical odds, the company may only get to about an 800 billion or 900 billion market cap on listing. So you're underwater straight out the gate on the SPV. And so, what happens then? And also when the value's dropping and different layers have purchased at different prices.
Well, in my case, it was going into a private round, which was like a price round led by an investor. So
always kind of tracking up and to the right.
Yeah. So like that round was at like 3 billion valuation. And after it closed, I think 6 or 7 months in, they raised another round at 9 billion. So anyone in that SPV would have done a quick 3x on that without having any, again, pass through because we weren't going to be charging anything on it.
Well, I'm glad you were escaping all the carnage from all of this, but it's pretty intense. Now, this is all global stuff. If we bring it back to New Zealand, Halter and local implications.
Yeah.
So Halter's just raised, what was it, like 400 million at like a almost 4 billion valuation Kiwi. As New Zealand companies get to serious scale, the question of the secondary market and the pressure will come to them too. And so kind of what's your take? Are you starting to hear what's happening here? Secondaries, I've got some interesting side anecdotes I've been hearing, but I'm keen to get your take on what's happening here.
Yeah. Well, the interesting thing about our market, like in New Zealand, is that when you think about like all these SPVs and this crazy interest in like the big tech companies in the US, there's a lot of like sophisticated investors, like professional investors, like funds, family offices, but there's also a lot of retail, which is why you have like these marketplaces that actually do pre-IPO listings for anyone to access. But we don't have that in New Zealand yet. And I think it's just generally our market is still young. People don't have that much of understanding of like the private markets to be able to like make those type of investments. So most retail is like shielded a little bit here from that, mainly because they probably don't even know that they can try to access it or even find a way to access it. But in saying that, there's still like the professional and sophisticated investors can still access, secondary stock, which is not primary directly on the cap table of the company, at least to start off with. And I think that's an interesting thing because once these investors start coming in doing secondaries, I feel like it opens a door to what it looks like for all other companies in New Zealand that could potentially be considering that. And as these institutional investors that might be doing secondaries kind of publicize this to the general market, to people, people also like regular retail investors start to now learn what secondaries mean as well. But I'm curious on your specific anecdotes that you have.
I mean, look, I think you're making some pretty compelling points. The anecdotes I have are more around some of the institutional folks globally who are trying to buy halter secondaries. And they're creating SPVs or they're buying odds at the prefs prices, but kind of forgetting that there's about $500 million in pref sitting above that. That's a different proposition than just kind of buying some more senior pref in an SPV. But we're talking institutional pools of capital buying odds.
Quickly, do you want to give like a quick 101 on ords and prefs?
Yeah, so I think ords, if you think about the hierarchy of equity for companies, ordinary shares are typically what founders hold. And common equity in the US, that's the parlance. Common ords, the rights associated with them are kind of, again, more like sweat equity type things. You've earned the right by earning, by working on the company. Investors typically buy preference shares. And so in the scheme of things, preference shares are essentially sitting higher in a stack. And in any sort of like exit or sale, the preference shares option get exactly what the preference implies. They get to either get the value of their shares back, the original capital, or they then get to convert to ordinary shares and get a distribution on a prorated basis of the exit. And so it's a mathematical formula, which is kind of what's greater. Is it greater getting back my capital, or is it greater getting a conversion to ords at a profit exit? And so when you're raising capital as a founder, you have multiple rounds, right? Seed, pre-seed, Series A.
Does have pref.
Yeah. And so you're sitting under a stack of capital.
Yes. Yeah. So that, I guess, highlights it when large institutions are coming in and buying ords as secondaries. They're still like underneath this massive stack of preference shares that the primary investors have, which is, an interesting place to be.
Especially in a growing tech ecosystem.
Yeah.
I'm excited to hear that that's happening. Like conceptually, it's awesome to hear institutional investors going, I want to buy a private company's stock. But I'm kind of nervous because it's kind of, there's this concept that we have in venture, which is rifle shotting. Like that's why you invest in funds. You kind of spread that risk. But if you're rifle shotting as an institutional and you're buying ordinary shares without protections, that's an interesting spot to be in an emerging ecosystem. But I just want to come back to that SPV stuff locally. Have you heard about SPVs being structured locally? Like I heard a little bit in the halter side about employee equity being packaged up in some SPVs. But have you heard anything locally?
Not at the scale of companies like halter. I've heard it more like much younger companies, like early stage rounds that might be looking for early stage investors. Like their investors probably just pool capital together and come in as a SPV.
Oh, gotcha.
Rather than like a secondary type SPV thing.
Gotcha. It's like a primary SPV to pull in people into the round. Yeah. But you've not heard of anything on like the employees or founders selling?
Not yet.
Yes, way too early, right? Yeah. So I guess is the market, the next question is the market small or like informal enough for this like to not happen? Or is it just a time thing for us to get bigger, more companies of the halter scale?
Yeah, I think it is more companies of the halter scale that people are interested in being in. And they can see like the upside from wherever they're entering. Because like when you, again, consider these large valuations, you're coming in like into a multi-billion-dollar company, you're buying secondaries, you really need to believe that there's still multiples here for you to make your, whatever return that you're looking for. So I imagine it is a mix of that, which kind of reflects against some of the young ecosystem part of things.
And I guess just to bookend some of the SPV stuff, in New Zealand, like our company's law, like does it restrict all of this? Because I've been, there are some VC funds who kind of hold their investments via nominees and all these holding companies. Like, what goes, what doesn't from the experience that you have had, like doing venture here, man?
I think like it depends. Like it depends what the investment is. It depends on the quantum.
Yeah.
And it depends on like how you are structuring it. So it's very much case by case. Do you have any other opinions on that?
Look, I mean, I think the key thing is the constitutions will dictate what you can and can't do. But again, it's an enforcement thing. Like, I think the converse is also true. Companies here are still young and small. So even a minor infraction probably does warrant like getting pissed off like by the board. And then they're kind of going, what are you doing?
Yeah.
Because there's not enough of you to hide. You know, like there's not enough of a group effort to be like, oh, we're all selling secondaries.
Yeah.
But so there probably could be enforcement. But it's interesting. Like all of this is creating flow-on effects. And so I'm curious to how all that global stuff starts to play out locally, especially with people seeking liquidity, trying to monetize. I mean, even last night at this another event, as a side note, I spend way too much time going to events. But like last night, there was this lady I met, and she was talking about how she put in about $15K in the Halter seed round about 9 years ago. And then she just sold it for like $1.1 million.
Crazy, right?
Amazing for her, right? Like, and that's kind of the point of all of this, like amazing liquidity uplift. But then she said something interesting, which was, again, she sold it via an SPV to a VC firm.
Interesting.
And, you know, I won't say who bought it, but I was kind of going, wow, like very interesting. And so what do you think that VC firm's doing with it?
That is fascinating. Well, the only thing that kind of makes sense is that they're either doubling down or they're giving liquidity to early investors, which is, you know, if it's just purely for that, that's kind of them. But yeah.
Again, you hear all these things and you're like, man, the market's evolving, market's changing. But you know, that takes us to the big dogs in the New Zealand ecosystem. So the Rocket Lab Mafia.
Yeah. So as we kind of get into like the Rocket Lab Mafia, maybe I'll give a quick kind of overview on what that reference means, like in terms of when we say X company mafia. And that's really in reference to the PayPal mafia. So PayPal, as most people know, is a big fintech company, one of the early financial payments platforms founded by Peter Thiel and Elon Musk and a bunch of others. And a lot of their early employees kind of went on after the sale of PayPal to build, you know, generational and foundational companies for the internet, including, you know, the likes of YouTube, obviously all of Elon Musk companies, Tesla, SpaceX, Yammer by David from Craft Ventures, and LinkedIn by Reid Hoffman, Keith Rabois, who was early at, you know, Square, one of the legendary VCs at a bunch of the large Silicon Valley firms. So the PayPal mafia references people who left the, you know, an originator company and then have gone out to build, you know, amazing things from there. So when we're referencing the Rocket Lab Mafia, we're talking about this, you know, one of New Zealand's giants in space tech who really spawned the aerospace industry in New Zealand. The people from that company who are now leaving, finding interesting opportunities, and now building their own companies around it.
Yeah, I mean, it's cool that we've got a company of that scale and size. But, you know, when I was in LA for the Upfront Summit, I saw the SpaceX Mafia alive and well, and that's pre-IPO.
Yeah.
Post-IPO, that shit's going gangbusters. And I think we were hearing like it's going to create a metric ton of millionaires, multimillionaires, potentially some billionaires.
Yeah.
And so profound impact. And I think people were saying more founders, more VCs, what have you. So cool, net cool. How do we feel about that with Rocket Lab? Are we seeing that, and this is purely an opinion take, huge respect to Peter Beck, Rocket Lab, and the early employees, but are we seeing that halo effect starting to touch ex-Rocket Labbers and kind of 72 billion market cap US? RIP, the decision I made to not invest 5 billion. I've been dollar cost averaging up, but are we seeing that halo effect?
I think we are. I think probably, again, coming back to Halter, I feel like we talk about it a little bit too much now, but Halter is one of those examples. But outside of that, there has been other founders who are ex-Rocket Lab who have gone on to build interesting companies, few that we have backed that, you can mention. But I think we're starting to see it. One of the functions of any of these type of mafias actually coming to existence, apart from the success of that initial company, is the employees that leave it to found their own companies. They need to firstly identify an opportunity that they think they can exploit, and the ecosystem that they're within has to be able to support that. And that's one of the things that obviously both of those things are playing out, where our ecosystem within New Zealand is scaling as well. We have more capital. We have investors that understand the market and can invest, who are supporting these companies. And now you're starting to see those early signs kind of come through.
I think that's a really good way to say it. Bit of a direct provocation here. Are the people who are kind of leaving Rocket Lab leaving with generational wealth yet? Or is that kind of still a foundational level of wealth? You can be super straight.
As far as I know, it's not generational wealth.
Yeah.
It's not at the scale of what PayPal was or what SpaceX will be for their early employees, which is an interesting conversation separately, why that kind of has ended up to be the case. But I think that is also what gives them that drive to that generational wealth. Now that they have such a strong experience building within a company like Rocket Lab, and then finding this opportunity to go and kind of really build into to get to what, in an ideal situation, they could have gotten some sort of generational wealth from Rocket Lab.
No, I agree. I agree completely. You mentioned kind of some of the founders who have backed and companies who have backed. Yeah, it's quite interesting. We've backed quite a great bunch of ex-Rocket Labbers doing cool stuff. Some we can say what they are, some we can't. But suffice it to say, most are still in the aerospace sector. But what has been interesting is we actually still haven't seen a good critical mass of aerospace startups. And that's blown my mind.
Yeah.
I think you can literally count on your hand one hand. I'm not talking both hands. I'm talking one hand, the number of aerospace startups spun out of Rocket Lab.
True.
And the number gets even leaner when you start to kind of go where are they in their journey? Kind of pre-seed, seed, Series A, and so it kind of really thins out. What's your take there? What's not working locally for that to happen, or still early time?
Again, in my opinion, I feel like it's a mix of two things. Building a business is not for everyone.
Yeah.
That's one thing.
Yeah.
So you might be a fantastic employee building stuff at Rocket Lab, not necessary that you want to become a founder. Also, you've seen that journey and you know how hard it is. So there is that aspect. And I think in general, at least what I've seen of the local New Zealand market, becoming a founder is still not as glamorous as it is in the US.
Yeah.
So people don't go down the path purely to be a founder. So if they're building something, they're finding real opportunities that they care about building for, which I think is more interesting, where it's a quality thing rather than a quantity thing. Mm-hmm. But again, eventually, as more of these companies scale, the ones that have left and have been building stuff and they're growing and building, we'll start to see spin-outs out of those. And I think the early seeds are there. But the quantity thing, I think, is a function of that type of thing as well.
No, I'm with you. I'm with you. One thing, in just conscious of time, we got to wrap up the pod soon, but I am conscious. One thing I want to see, and I think Peter Beck's been doing a lot of it, but what's he worth now? Almost 12, 15 billion US dollars.
Yeah.
Just sprinkle some of that good money on the ecosystem
Yeah.
in quite a prolific way. And I think we'll see a great kind of flourishing of startups. I think he's doing it in like small ways still, which is, again, no indictment. This is just me being a lazy venture capitalist sitting on a podcast, taking hot takes and kind of saying to others, do better, do more. But it's kind of, you're getting a 15 billion US in net worth. I don't know, conservatively sell about a few hundred million of that, sprinkle that on the New Zealand venture ecosystem.
Yeah.
See what happens.
Yeah. And maybe to play devil's advocate, like a big part of, like a founder like him selling his stock.
Why? Yeah.
Is like, why? Like, does he think that 100 million he sells is better return within his own business? Or if it's purely for impact, then that's a different conversation. But, most people get into this game not for impact.
So I think that highlights a really core point, which is the common thing I have heard about is there's not enough done by like super wealthy founders like him. But I think you paint a really compelling picture. If his business is growing, he has a decent amount of equity still in it. Why would he be selling out? Because and it's not that he doesn't see value in growing the ecosystem. It's just that the compounding value of his Rocket Lab equity is worth far more than it could be about even from a philanthropic side of like developing the New Zealand tech and venture ecosystem. So I think that's a really strong, compelling argument. That's one thing I hear constantly is like, he's not doing enough. I kind of see both sides. But again, it's an interesting provocation. But I'm excited. We've got companies like that. Shout out to the aerospace companies in the GD1 portfolio, Zeno Astronautics, electromagnets for space applications, all the way from like fine attitude control, in space electric propulsion, charged particle shielding, all the way to Dawn Aerospace, absolutely killing it. These guys started with a clean thruster, doing 200 plus thrusters in space now. And then a suborbital space plane, horizontal takeoff from civilian like runways. I think they've sold a space plane to Oklahoma Spaceport. How cool is that in the US?
Futuristic stuff.
I know. And then most recently, our newest investment, can't name what it is just yet, but a great team building a fleet of satellites for reusable satellite platform for microgravity R&D and manufacturing. And
such an exciting space.
In space logistics. So it's cool. This is all coming. Takes time.
Yeah.
But super exciting period we're in. Now, that's it from kind of the core topics for today. I had fun, man. That was a wide-ranging conversation.
Yeah. And I think to bring it back to like the first episode, we got some incredible feedback, which was, encouraging and exciting. And we're obviously going to keep trying to do this more regularly as time permits. But it's fantastic to be able to get this one out.
Awesome. Yeah. Thank you all for listening. Peace. We'll see you on the next pod.